Now, let's help you out with bond yields. Remember, it's our aim to also educate you so that you are better equipped to handle your own finances. First up, jargons simplified. We are going to take one very difficult word that many people do not understand and try to simplify it for you. Portfolio YTM. This is a very common term that is used especially in the fixed income market. Now, what exactly does it mean? You know, like Mr. Rustagi said, in a particular fund, there are various securities that are held, be it corporate bonds, that's just for an example, Tata Steel may have issued debentures and you're holding it, or maybe it's a government 10-year bond. Now, the debenture from Tata Steel may just be held for 5 years, whereas the government bond will be held for 10 years. Now, what will be the return of that fund if both these securities are held all the way till their maturity? If in case these securities may be sold before they mature, then the return will be different. So that's the reason why a portfolio YTM or a portfolio yield to maturity is an important figure in the world of fixed income markets. Well, moving on to our Mythbuster segment, where we will try and bust the myth that does exist in a particular segment. This time around, it's going to be on Gilt Funds. Gilt Funds, which, like I said, hold government securities, are risk-free. And that's really the case, you know, because when one does believe that they are lending money to the government of sorts, they do tend to be risk-free. However, they are not necessarily risk-free. They always carry an interest rate risk. Yes, the government will not default on its payments. However, like I said, the interest rate is fixed. The government will only pay you a particular interest amount. However, in the market, the interest rate may be higher. That's what an interest rate risk is. The NAV will drop if in the market you're getting a better interest rate, because why then should you invest in a gilt fund which will offer only a particular interest? That essentially is the risk that you do carry when you invest in a gilt fund. Okay, I hope this has made you a bit wiser from here on, but now here is a treat for all the investors of the Axis Large Cap Equity. It's one of the largest ELSs. In fact, it is the largest ELS as so far in the market. So we decided, let's bring on board Mr. Jinesh Gopani, who is the manager of the Axis Long Term Equity, for the benefit of the existing unit holders as well as the prospective unit holders. First up, let's go across to Jayesh Khilnani for a wrap of what are the constituents of this large cap fund. Hi, Jayesh.
Well, the fund on radar today is the Axis Long-Term Equity Fund. Let's start off firstly with the performance that this fund has delivered over the last 1, 3 and 5 years. In the 1 year, you can see that it has delivered as much as 7%, and it is the long-term return, which is the 3 and the 5 year return, that the fund has given you about 13 to 15% each. But as far as the portfolio turnover is concerned, or which is also popularly called as the churn of the portfolio, that stands at a little higher on about 60% odd. But the healthy performance that I was referring to in the 3 and the 5 years, it will become evident over the next 2 slides when you have a look at the sector and the stock composition of this particular portfolio that we have. Financials dominate the space at about 44%, followed by IT and consumer names, which combined have a weight of about 25%. Even in the top 5 stocks that we have listed over here, 3 of them belong to the financial space, while you have the odd Pidilite, which also makes it to the top 5 of this portfolio. But with that, let's also welcome in Jinesh Gopani, who manages this fund and is also the head of equities at Axis Mutual Fund. Jinesh, firstly, thanks for taking the time out and speaking with ET Now. Let's begin with what is the basic investment philosophy that you follow while managing this particular fund?
So I think the basic theme is, when we started this fund in 2009, the approach was to differentiate something to the investor community, because you were 42nd mutual fund who was starting, and how to differentiate yourself from the rest of the pack. And given our experience of doing long-term investing in our earlier organization, the key top management team came together and brainstormed in terms of how to take this on a long-term investing mode rather than taking a daily NAV kind of an approach. And since it's a 3-year lock-in fund, we thought the idea was to have a multi-cap strategy with a view to invest with 3 to 5 years in any stock where you are buying, and hold it on for a longer period of time as the business models grow. So idea was long-term investment rather than a very short-term trading approach. Idea is, and we have been doing continuously, is to identify new ideas, new themes which are evolving in India and which can give you higher than average returns from the sector where they are. So the strategy is a growth strategy. The philosophy is the corporate governance plays a very important role. We take a big bet on the management after doing our in-house assessment, and if we go right, then I think money making opportunity is very, very big. So this was the approach we started with, and we are continuing it even at this juncture.
Well, Jinesh, this is the largest ELSS scheme that we have in the Indian mutual fund industry. So what is the management strategy that you follow for this fund?
So there are different types of risk when you invest. So the first risk what we see, as I said, a management risk. In India, with our experience, we have seen that even if the company is good or the sector is good, somehow if you go wrong on the assessment of the management and his intentions of creating wealth, then I think you lose a significant amount of your wealth in those type of management. So management risk is the biggest risk what we try to ascertain and try to ensure that you don't go wrong in this. The other risk is the business risk. So in this disruptive world, whether your business itself will be thriving after 10 years is what the question we ask ourselves and we ask the management. And if we feel that the business is not a scalable business model, then we stay away from it from the larger part of the portfolio construction. The third risk what we see is from the market perspective is the liquidity risk. You might enter into a good stock, but if there is no liquidity in that stock, maybe even after 2-3 years, then I think it becomes difficult for you to exit those stories. So don't go wrong on the liquidity side of the portfolio. As long as we are able to have a balanced liquidity approach in our portfolio, we are okay with that because it's a 3-year lock-in fund. So these are some of the risks we take into account while assessing a company, assessing the management, assessing the business models. And if you go right and if you have a view which is a positive view, then you go and invest in those stories.
Jinesh, also talk to us about the risk management processes and strategies that you adopt for this particular fund.
So see, as I said, our philosophy is simple. In India, we have a land of entrepreneurs. There are many entrepreneurs who are hungry for growth, who are good in corporate governance, relative corporate governance, and who really wants to create wealth for themselves or for the investors. So we try to pick and choose those 1 or 2 names or maybe 3 names from the sector and try to analyze more, do in-house research, channel checks as much as possible. And if we think that the business model is secular, scalable, and can generate higher ROEs as compared to the industry averages, then we invest heavily into that. So the basic strategy or philosophy, I may say, is take bets on the management. Pedigree of the management is very important. Relative corporate governance is a very important part of our parameter to weed out companies. Look for quality and sustainable secular businesses which can grow for maybe next 10 years, 20 years, and ultimately those businesses should generate higher ROEs as compared to industry averages.
One final question, what would you like to advise the fund investors, both the existing ones and the potential customers that you have?
See, I guess the idea is to identify great companies run by great management or great promoters. We feel that if you are able to identify those companies who are growing at a higher than average cost of capital in terms of their return on equity, I think the returns are there to be made. And we have now history of last 10 years in Axis, and also you have history of the other funds as well who are in the market for last 15-20 years, and the returns have been pretty healthy for some of the funds. So I think the idea is do systematic investment. Don't churn the portfolio for the heck of churning the portfolio from one fund to another one. If you are happy with the construction of the portfolio, be with them with a 5 to 10 year view.